So next up, we've got another great event for you guys, the Fundraising for Texas Startups in 2020 panel. This session is going to cover the recent trends firms are seeing in the Texas venture market and give a little bit of background on how it's impacting their approaches to investing. Founders are going to have the opportunity to hear from partners from the largest and most active venture capital firms in Austin, which are Silverton Partners, S3 Ventures, Liveoak Venture Partners, Next Coast Ventures, and True Wealth Ventures. So without further ado, I'm happy to invite to the stage Carrie Rupp, General Partner at True Wealth Ventures, Mike Dodd, General Partner at Silverton Partners, Charlie Plausch, Partner at S3 Ventures, Krishna Srinivasan, Founding Partner at Liveoak Venture Partners, and finally, Thomas Ball, Co-Founder and Managing Director at Next Coast Ventures. Guys, thanks so much for being here with us this morning.
Thank you for having us. I'm going to try to share my screen and see if this works. All right, can everybody see that screen? There we go. So as Jake said, my name is Charlie Plausch. I'm a partner with S3 Ventures here in town and the moderator of this wonderful panel today with these esteemed panelists. We had a very similar panel last year, so great to have everyone back this year. How this will work is I'm going to run through just a few slides on the VC fundraising environment overall nationally. We'll take a little bit closer look at Texas, and then we'll jump into panel questions with the panel. At that time, I'll have the panelists introduce themselves and give a background on their firm. And then we will have a few minutes at the end for Q&A. So if you have questions as we're going through this, put them in the chat area, and we'll try to get to some of those towards the end. So if you look at this chart, this is a chart of national fundraising starting all the way back to 2006. The blue line at the top is the total number of companies funded annually, and then the darker bars are total number of dollars raised by those companies. And so as you can see, much more modest fundraising years towards the left side of the chart, nice increase in kind of 14 through 17, and then a big jump in 18 and 19 as we saw the growth in the later stage rounds of companies raising, 300, 400, 500 million or even more. If you look at the first half of 2020 on the far right, and you think about impacts from COVID, while we have seen a slowdown, if you look at total dollars invested, we're on pace to still maybe be in that same range of 18 and 19. However, on a kind of a deal count basis, it looks like it's lagging a little bit, but not drastically. So I think we're still on pace to get somewhere in that 18, 19 range for the year. So it doesn't feel like the COVID impact has been too drastic. This next chart is the exact same chart as before. It's just broken down by quarter, starting in 2016. And so like the chart before, the blue line at the top is the total number of companies that are funded per quarter. And the darker bars are the total number of dollars deployed into these companies. If you look on the right side of the chart, there was a nice, pretty large drop in Q1 to Q2 of total companies that were funded. However, if you look at the darker green bars behind that, you can see that actually dollars deployed was pretty steady in the $35 to $36 billion range. So we think that likely signals that you saw fewer, earlier stage companies get funded maybe in Q2, and the later stage market with larger kind of monster rounds stayed pretty robust. Another interesting insight from this chart is just looking at the gray bars in 16 and 17, and the average capital deployed per quarter then was 21 billion. And then looking at the green bars on the right side, it's up to 35 billion. So well over a 50% jump on those two time frames. So still pretty material. And even when you look at the drop in total companies that are funded, even in Q2, you're still only kind of around Q4 of 16. So even though we saw a pullback, we're coming off of record highs of funding. So still a pretty robust venture fundraising market, we believe. I won't read you all these headlines, but everybody on this panel knows that Texas has just been going gangbusters. All the big tech companies here are moving, setting up offices in Austin and even Texas more broadly, and hiring thousands of workers. And we just think this is really robust for the tech ecosystem here. That'll be a net positive long term for the Texas market. Some other interesting data points we found on migration to Texas. If you look at the chart on the left, this is total top 5 migration by state. And as you can see, the top 5 are all from California and New York, with the top one being California to Texas at almost 50,000 people. It is worth noting that was 2018 was the last accurate data we have. It's going to be really interesting to see what those numbers are for 2020. As I'm sure the other panelists have seen, anecdotally, I've talked to lots of people that have moved from California or New York that are taking advantage of working remote and living in Austin, and they're looking for tech jobs here or working remote for their companies on the coast. And then on the right side is just a snapshot of one bedroom apartment rentals year over year in July. As you can see, again, San Francisco, New York, top declines in one bedroom rental markets, and Austin all the way down number 30 is actually a 6% increase. So pretty interesting data points, all kind of pointing towards more people moving to Austin. Here's a total count of deals done year to date in the first half of the year. Capital Factory talks a lot about the Texas Manifesto. We're believers of that at S3 as well. And so if you look at Texas as a whole on a deal count basis, we're number 5 in the country. Obviously, a little bit behind some of the coastal areas. If you look at Texas fundraising, again, this chart, the line has total number of companies funded per year, and then first half of the year and second half on the right side. And if you kind of look at the left hand of the chart, in 2016, Texas companies raised just under 1.5 billion. And then by 2019, that number had climbed over 3 billion. So more than doubling over that time period, which we just think great sign for Texas overall. And if you look at the first half of this year versus first half of last year, on the right side, we did see a decline year over year. However, it wasn't drastic. And we're still on pace to kind of be in that 2018 range from a total dollars deployed. And so we still feel like it's robust, and based on what we've seen with deal flow and companies getting funded, we think it'll be, an even better rebound in the back half of the year, and the COVID impact won't end up being, drastic to the funding environment. This last chart is by quarter for Texas companies that have raised and stage. We were able to get the Q3 numbers that just came out here the last day or two. And so we've got it broken down with seed, Series A, and Series B. So as you can see, our seed companies getting funded has remained pretty steady, although we've seen a pullback in Series A, but Series B has actually increased over Q2 and Q3. So with dollar volume remaining pretty steady. So our view is that pretty positive for Texas overall, and we've seen some of the later stage companies continue to raise money along with early stage. So net a positive. This last chart is just a quick snapshot of a bunch of the logos, including all the ones that are on this panel today. We think this is just a great time to be an entrepreneur in Texas. There's more firms than ever writing checks and actively deploying capital in the Texas ecosystem, and we're excited to be a part of it, and look forward to see what the future holds here. With that, I'm going to turn it over to our panelists. If y'all could each take just a few seconds and introduce yourself, your firm, and what your focus is, your check size, and then we'll jump into some questions from there. And Carrie, how about we start with you?
Sure. Okay. So hi, I'm Carrie Rupp with True Wealth Ventures based here in Austin. We are a $20 billion seed stage fund. We have a pretty explicit thesis. So we have a really narrow area. We focus on women-led companies, which are companies with at least one woman on the executive team. As it turns out, in the 10 companies in which we're invested, 9 of them, it's the CEO who's the woman. But it's really about diversity. And we specifically invest in the impact verticals of companies that are improving human health or environmental health. We are investing, truly at seed stage. So our first checks are around $500K in this first fund. We're generally trying to lead deals and take board seats. So we're pretty hands-on, and our whole portfolio will just be 12 companies. So, it's pretty discrete thesis. We wish we were investing more in Texas. And so we're excited to be on this panel and always engaging with the Texas community. Right now, only 2 out of our 10 companies are Texas-based. So if you're in those verticals and you have a woman on your team, please reach out.
Mike, you want to go next?
Sure. Mike Dodd from Silverton Partners. We've been around for about 16 years. World headquarters is in Austin, Texas. Sitting in our office right now. We are early stage kind of seed Series A firm. Our general check size, initial check size, is between $1 and $5 million. We are typically the first institutional money in our projects, and we're generally don't do pre-revenue investments. We're looking for kind of $500,000 to $1 million in annualized run rate. About 65% of the portfolio is enterprise, and the remaining is consumer tech, with a little bit of kind of direct-to-consumer CPG sprinkled on top. Yep.
You couldn't do it, Charlie.
No, I was saying Krishna, maybe?
Oh.
Hi there. Krishna Srinivasan, founding partner of Liveoak Venture Partners. Partners and I have been investing in early stage venture in Texas since the beginning of 2000. And then at Liveoak starting in 2013. To date, we have invested in probably 35 companies since that time period. Our strategy is to be first institutional money for all Texas-based companies. At least the core critical mass of founders are at least based in this market. First check for us is, you go as low as $500,000, $half to $4 million check sizes is typically what we do. So in that instance, again, first institutional money for these companies. Portfolio mirrors where you got world-class companies in this market. So look to build category leaders that come out of Texas. Therefore have a big bulk of enterprise software, tech-enabled services kind of companies in the portfolio.
Good.
Hi, Tom Ball. I'm the co-founder of Next Coast Ventures. I've been in Austin for about 15 years investing now. We started Next Coast in 2016, closed our first fund of $90 million in 2017, second fund of $130 million last Q4. We focus on Next Coast markets, not just Texas, although about 70% of what we've done is in Austin to date. We live here, we like to give here. We are early stage tech investors, kind of like everybody on this call, and we kind of fancy ourselves to be more thematic in nature. You can look at some of our themes on our website, which are constantly updated. From a stage perspective, seed to Series B, we'll go as small as a couple $100,000 in a seed project, usually with a strong syndicate partner. And then in the later rounds, kind of sweet spot for us, kind of from A to B is anywhere from $3 to $10 million for an initial investment.
Thanks. And just a quick overview on S3. We've been around investing about 15 years, currently in our sixth fund, which is about 200 million in size, primarily focused very much on Texas. We've made roughly 45 investments over the history of the firm, and 42 or 3 of those are in Texas, with the majority of those being in Austin. Like Tom said, we'll get involved with a few hundred K in a seed round, and we can get as high as 8 or 10 million on a Series B, with kind of the typical investment being 3 to 5 million in a $5 to $10 million round. Yeah, so I can stop there. We can jump into questions. So we don't have a ton of time here. Obviously, panelists, we have had some crazy stuff going down. We're dealing with COVID and how that impacts our portfolio companies. If some of y'all could just give some insights into when COVID hit, how did your companies react? What type of decisions did they make? And then how has that kind of changed as the economy has somewhat rebounded out of the initial impact in the March, April timeframe?
Well, I can go. I mean, it's so industry dependent. So we are actually invested in a seaweed company of all things in Maine, and they had made huge amounts of progress in food service. So Sweet Green, for example, had just done a $2 million, ad campaign with them, and then restaurants all shut down, and that was the core of their business. And so they had to shift really quickly. They did have some retail products, so like a seaweed salad and a kimchi in jars, but had really just started working with supermarkets in the small, kind of hippie supermarket category, and all of a sudden had to start working with Sprouts and Whole Foods and all these things to really shift strategy completely, which means different skill sets, marketing dollars, resources. So it required a pretty serious adjustment. Charlie and I are on the board of a company called Brain Check, and they're actually in the healthcare market, but they do cognitive testing for brain concepts. And so they're really focused on the elderly and dementia. And of course, it's usually during your well person exam to see if you're getting dementia. You're not going to go to the doctor at the beginning of COVID in February if you're a senior citizen. And so they, shifted pretty quickly to add telemedicine capability, which was, on the roadmap but hadn't been prioritized. So it really did require some shifting. As it turned out, things started picking back up, and people are doing visits, et cetera. And so I think there was definitely a period of stop, assess what's critical. Some companies had to lay people off that were just no longer core functions. Some companies had to raise a little bit more money to make sure they had the tenure to last through to being viable. So there was definitely a period where we as investors were a lot more engaged, in March, April, in making sure our current portfolio was positioned and had the resources it needed to do what it was doing before we could shift back to investing. And I think startups that are watching are usually worried, are people still investing? I think it's from what I can tell, everybody is, but there was a pause where we focused more on making sure to shore up our existing portfolio first.
Yeah, I mean, I'll go. I mean, I think that was a great answer, Carrie. Like everyone, I think most of our portfolio companies were very deliberate, kind of cautious at the beginning. It varies, as Carrie said, across what industries they're focused on. I think the consumer stuff probably was more cautious than some of the enterprise stuff that has more recurring based revenue streams. I think they all frankly made very hard decisions, and most all of them hopefully have come through it stronger as a result of that. I can remember going through multiple iterations, one particular company about 6 iterations of their financial plan over the next 12 months, which seemed like maybe 3 iterations too many, but I respect them for being very deliberate about it. And I think, as you said, Charlie, the economy, at least the public market economy or public stock market, has seemingly gotten better since it all started. And it feels like the tech stuff is all doing pretty well. So I think everybody made hard decisions, but now it seems to be more back to business as usual.
I would reiterate that. I think, we all absolutely feared the worst when it was all broke in March, with a significant amount of conservative planning as to what needs to happen. But in general, I would tell you that companies have done a lot better than what I would have expected. And especially in segments where use of technology has gotten accelerated compared to what it was ever before. Segments such as real estate, we have a lot of exposure to tech and real estate and prop tech, and that's definitely been a tremendous positive in this market. In others where remote working and enabling that with technology has been incredibly positive. Of course, we do have our share of a couple of companies with bigger exposure to challenge segments like commercial real estate, for example, which have struggled with actually closing deals. But I would say by and large, it's been better than what we might have predicted, when this all began.
I'll flip the next one over to you. Just kind of follow up on that. There's a lot of talk right now about companies working remotely indefinitely. Are they renewing their leases? Are they, reducing the amount of office space they have? What have you seen in your portfolio, and how do you think this will pan out over the long term with people working remote versus in the office?
Sorry, was that to me?
Yeah, I was directing.
Yeah, so I'd say obviously most of our companies are still working remotely. I'd say, and this is a wild guess, maybe 20% didn't renew their lease or got out of their lease, and are going to try and stay remote at least for the next 9 to 12 months. I think ultimately it's going to be hard to do. And again, this is my opinion, just how do you double, triple in size the organization, grow to 100 people and still kind of have that culture? I think it's just really hard to do. We've got a couple kind of companies that are headquartered here. We got one in particular that's headquartered here, but it's pretty global in nature. They've got people all over the US and then a big team in the Ukraine. And I think they're probably going to stay virtual primarily. So a lot of it just starts with the founder and how comfortable they are kind of building out a distributed organization. And, but I kind of believe we're never going to be back to where we were, but I think we're going to get back to 70 to 80% of what it was. Just because I think people ultimately have more flexibility, and offices will become, or desks will become more of a hotel type orientation versus you'll have a specific desk. But I think culturally you're going to need to have a home base. Because culture is what drives a lot of these businesses, particularly in the early and mid stage of growth. And, it's much harder to do culture like this.
I tend to agree with all those comments. Any other thoughts on that topic?
No, I think we all agree with Mike on that. It's changed the way people work. And the only thing I'd add on, and I agree with everything you said, but the only thing I would add is I worry long-term as we think about, or entrepreneurs think about exiting their businesses, how acquirers start to view this remote work. Because, diligence now when a company gets bought is the acquirer generally comes to the office, meets a bunch of the team. And if people are completely virtual remote, I as somebody who's bought some companies in my life, don't think I get as comfortable in an acquisition kind of situation as I might in the old days.
Yeah, that's a really interesting point. Another question just around how COVID has changed the diligence process. I know all of our firms have funded companies since COVID started, and it's definitely been a different process. How has it changed your diligence process and how you interact with founders in this COVID world?
Zoom. We had actually, just because of the nature of us investing across the country, always done phone calls first anyways. So, at some point, the top of the funnel wasn't all that different. What we're having to do, though, is to get that comfort level that you're really starting to build rapport, because it's so important that you're going to be working together through the up times and the down times with the company, that you actually can work well together, that you can manage conflict, you can see if they're responsive to mentoring, etc. You really need to spend a lot of time together, and you aren't doing that physically. So we've just engaged in Zoom a lot sooner. We've actually engaged in Zoom a lot more casually than we have in the past, right? Normally it's a formal meeting and maybe we're dressed up, etc. And we've started to do more what I'll call real life Zoom calls, where you're rushing in between meetings and you're in a baseball cap coming from a workout, but you want to connect with the founder. So it's maybe our virtual equivalent of, having dinner with them, or, going out for a drink and talking about real life, and trying to actually have some of those conversations about other personal interests and things like that would normally come up casually in the course of, getting to a cab together or whatever. It doesn't sound like, due diligence, as Charlie mentioned it, which is much more about, getting to know the market and all of that. We still do all of that. But I think what's changed is trying to figure out how you replicate the dynamic of building an actual relationship virtually. And I don't know that we're experts at it yet, but those are kind of the things we've done to try to attempt it with multiple of the team members too. Whereas you might have been doing a lot of the fundraising content, with the CEO, but now we really need to engage with the rest of the team. To Tom's point, we're not going to the office and meeting all the other team members. So we're trying to figure out how to do that in virtual settings.
While we have done 4 to 5 investments since March began, they've all been in entrepreneurs with whom we've had multi-year relationships before even before this time period. I don't think we have done one where it's a brand new relationship that got built up, completely over Zoom. So I think, this is very much a people, relationship, chemistry business. So on both sides, right? It's how the venture guys relate to entrepreneurs and how the entrepreneurs relate to the venture folks. So I think we are still of the old school perspective that, look, let's get as much work done as possible over Zoom, but ultimately, before things get to the finish line, there has got to be at least a couple of face-to-face meetings so that you can go establish that chemistry. And our pattern matching filters aren't quite yet refined and sophisticated to grab all the nuances on both directions over Zoom. So we are still in that philosophy of, if it's a brand new person, brand new company, we've not had a relationship before, we will end up in a face-to-face meeting before we ultimately get to the finish line.
Yeah, we've done, 4 or 5 deals since COVID, and we've got 2 more signed, and we've met every entrepreneur in person, typically outside. And I think all those were in Austin. So we still want to meet them. And we've got one that we're close with out of New York, and they've actually come down here. So.
Yeah, I think we're similar, although we have a couple of portfolio companies who have actually raised follow-on rounds, and they have not had to meet the new investor in person, which I thought was fascinating. Did it all over Zoom.
Yeah, we've had some that have raised $50 million all through Zoom. It's crazy.
All online. It's crazy. I think we'd be willing to consider not meeting them in person. Everybody has different ways they're dealing with this and different circumstances that would drive them to want to meet or be able to meet in person. For the right deal, I think we would. It's interesting. I think the entrepreneurs seem to want to meet in person kind of what Christian said there, where it's a two-way street, right? It's not just us wanting to meet in person. Most of them want to meet in person too. So we just did one. I don't think we've announced it yet, but on the East Coast or in North Carolina, where the entrepreneur flew here to meet us. I think he wanted to meet our whole team and understand who he was getting in business with as well. So it's a two-way street.
Yeah, we actually funded one that hadn't been announced yet that nobody's met in person. We did not know them previously and have not met in person. It was actually a cold email. So interesting to hear that a lot of them are still meeting in person. A recent article came out that was listing a lot of West Coast VCs. Briar Capital is a big one. Briar Capital that just moved here, and some others that are looking at hiring a partner here in Austin or opening an office here. How do you all think this will impact the Austin investing landscape? These California firms put up presence.
I think it's tremendously net positive here, undoubtedly. we all will absolutely benefit from more capital being available. We are continue to be pretty capital starved here as a town, given the level of activity in this market. But in all these instances, these companies require a local lead investor who's got depth of relationships to help in the company building process. I think even companies coming here recognize it. Venture firms coming here recognize that they would like to have a local lead investor who's got that history, institutional knowledge of the market and the people here, and they'd like to join them and be part of the syndicate. So far it's been very constructive. Like, Briar has done 5 investments to my knowledge in town, and 4 of those they've joined us in that syndicate. And so it's definitely been quite collaborative so far, and we hope it remains that way.
Yeah, it's a net positive for everybody. It's a net positive for entrepreneurs to have more sources of smart capital. It's a net positive for the investor community to have more syndicate partners. And frankly, I think having smart people move to town, come to town to make investments kind of keeps us all on our toes a little more and makes us remain competitive and not try to dominate.
Changing gears a little bit, let's move into kind of some basic fundraising advice info. So I think everybody mentioned they're investing some level at the seed stage. What are you all really looking for at the seed stage? What's the kind of number one factor you're looking for in those early days of company raising money? Anyone?
I mean, look, it's also entrepreneur dependent at the early stage. So I think all of us would say people is, in the top, and it's a hard one to quantify because it's some, magical balance of persistence towards this really challenging goal, but actually also responsiveness to the, not bullheadedness or stubbornness. So responsiveness to the customer and the market, hopefully some responsiveness to their investor and their advice, et cetera. And then a comprehensive team with, different skill sets, but then obviously also the size of the market opportunity. So one of the key things when we're having a venture capital panel is to really think about whether venture capital is the right kind of funding for you. And so, we have specific dynamics around wanting to have these really big returns. Different size funds and different theses, have different senses of how is that a 10x or a 20x or a 5x or whatever, but we are really looking for huge big market opportunities. And so there are plenty of interesting businesses that aren't suited for that, and I just think it's an important thing to give in context in Startup Week that raising money does not mean raising venture capital in particular. For if an investor like us invests, you have a pretty high hurdle in terms of how big it's going to get. And so the size of that market and how big the pain is it a top of mind pain for the customer versus a nice to have, and a number of other things around that are really key. There's probably 1,000 other things I could mention, but those are, 2 of the top ones I think you ought to consider.
Yeah, it's people, market, product, typically in that order. And it's honestly not that much more complicated than that. And there's no rocket science to this. It's just, ideally we invest where we don't do pre-revenue. So there's some data that we can digest and kind of grind on. So that helps too, but it's ultimately, people, market, product.
Yeah, that's well said. I mean, for us, we don't typically lead seed rounds. We like to partner with people. So for us, it's kind of also, in addition to everything everybody else said, kind of quality and alignment of the syndicate with us to make sure, to Carrie's point, we're all playing for a similar outcome. And I think the other big thing that we always look at is future financing risk. Like, is somebody else going to come put more money in this in the future?
For us, it's those 3. I think hard to be additive to this esteemed panel's perspectives here. But I think look, we end up compromising on, for example, market interaction for exceptional people, right? We just did one along with one of you all, where it's a pre-revenue, pre-product company with an incredible entrepreneur here in this market. So I think we definitely over-index on people and would be willing to compromise on with lots of domain knowledge in a certain space, and we definitely do compromise on elements of traction, ultimately to do that. Or even market sometimes, but often it's in that order.
should entrepreneurs determine how much capital to raise in their next financing? Would that be in your portfolio or entrepreneurs coming into your office? How do you typically guide them, or that? How should they think about framing that up?
I mean, you got to have enough to get to the next milestone, right? To get to the next milestone of value creation or risk reduction, where when you need more money, you've shown demonstrable progress to get to that, to get somebody else to invest, or to get your current investors to continue to support you. And if you believe in software development rules, maybe multiply that times 2, because it always takes longer and more money than you think it's going to. But and it's also kind of from a time banding or bounding perspective, probably no less than 18 to 24 months of capital, I would suggest, just to, again, give yourself some time to get to the next milestones.
I guess I'll just clarify on top of that too many entrepreneurs just focus on this gets us 18 months or gets us 24 months and don't know what the next milestones are that matter, right? So you really need to think about, to Tom's point about the future financing risk, what does the next kind of investor that you need to see in order for you to be fundable and back into, like, how do you get there, right? You might be like, oh, I can get 18 months with this. But if you're 18 months further along, but you haven't actually achieved something demonstrable that actually increases your valuation and also makes you investable by the Series A investor or whoever's next, it's irrelevant. And so really thinking about on your ask slide, not, hey, we need this money to hire these people, but it's to achieve these things that makes the next set of investors excited about us.
Oh, another way to think of this is it usually will become apparent along with your lead investor, what is the core risk that people are underwriting at the stage? Is the risk you're underwriting that, look, there is not a repeatable purchase by a customer, for example, they bought it once, and what will happen to renewals might be a question, or can you scale usage might be a different question. So at least have a comprehension of what is the core risk that current investors are underwriting, and which of those risks you need to go and tackle and eliminate as a part of the current financing. And go take care of that, and have raised enough capital to get past that and get through to the expression of next key milestones of this business. Would be another way to look at this problem.
All good thoughts. Next question is, what's the best way for a startup to really differentiate itself when it's getting in front of you, whether it's a warm intro or a cold email? In the sea of companies that are trying to get your attention, especially in the COVID world. Mike, how do they get your attention?
I'm trying to think here. So the best way is to get a warm intro from somebody that knows us. That's the easiest way. And cold emails. That's why I love that you guys funded a company, Charlie, with a cold email. That's awesome. I'm not sure
it doesn't happen often.
Yeah, no, but that's great though. I mean, that gives hope, right?
Yeah, Chris did that with Disco too. That was a cold email, wasn't it?
Oh, did you really?
That.
Indeed, Disco was a cold email, right? And it gives hope to the. Sorry, I missed that, Tom. What did you say?
It's made me read more of those cold emails.
That's the sole reason I keep reading every single cold email, because in 2013 October, I got a cold email from a guy called Kiwi from his assistant called CC, and I take any such emails very seriously.
That is awesome. Well, there you go. So we need to do a better job. Anyway, so cold emails do work, I guess, but ideally you get a warm intro. So that's the best way to get attention. And short, concise, clear what you're trying to do is always efficient.
I guess I'll just add, because Charlie, you sort of said once you're in the flow or whatever, is for me really demonstrating a really deep understanding of your business and also your customer's business and what's driving them, et cetera, and really having thoughtful, deep answers to how the market works and how you're structured and how the business model is going to work. Really thorough answers. It just becomes, you can move so much faster if you're getting really deep answers from that entrepreneur. And maybe, I'm not sure how that's actionable other than, just a response back to an email isn't helpful. If you can actually get some content in there or set up a call and prepare, some slides in direct response to the questions we had. You can move a lot faster if you're actually like really delivering substance. And so we definitely find that things move faster if we're getting, good, deep content earlier, heartier stuff.
And I just was informed that Silverton has done a cold email investment recently. So
you get buzzed under the table.
I did. And the other thing I'd say too is that, being an entrepreneur is ultimately about getting around brick walls, because there's so many challenges that you're gonna have to figure out how to get around. And if you can't figure out how to get an intro to Krishna or Tom, then it's unclear that you're going to be able to that's the easy part. The hard part's building the business, right? And so, we would hope that plenty of people know us around Austin and around the country, that you should be able to figure out how to network into us.
But Carrie said something earlier. I can't remember what the question was, but it was also know the investor, what they invest in. The worst ones are the intros or the cold emails that are something that we would never ever fund, whether it be some sector or focus that we just wouldn't do or something like that. So it's that's the way not to do it, I guess.
Actually, just to piggyback on that, I can count literally on one hand every year the entrepreneur who actually writes, "Oh, I saw that you invest specifically in this, and when you invested in this company, there's a really similar thesis to this." I mean, literally, out of the 500 deals we're looking at, we'll see 3 or 4 where the person actually customizes it to, but we're worried you might not be interested because you didn't do this. And we're like, oh my God, we're giving that person time regardless, because they actually did take the time to qualify the lead, and actually customize the thing you would do with your customer. Hopefully, you can also do with your investor.
Yeah, I would totally agree. Most of them are not relevant to the firm's focus and structure. I think we got one for a catfish farm in Germany one time or something. But but the one we did fund, it was a very concise email. It was personally tailored to me, and had some very interesting stats and data, not 10 paragraphs of information, and caught my interest. This short deck that I could get through that got us excited about it, and we set the intro call and went from there. And Krishna, I imagine it was a similar email from Disco years ago.
Sorry, was it a question, Charlie? I'm sorry.
Oh, no, I was saying, I imagine it was a similar email,
exactly.
And tailored to you.
Indeed.
Let's see here on next questions. Now we're going to try to save a few minutes at the end for some Q&A. If a company is lucky enough to get multiple term sheets, get VCs interested, how do they decide which VC firm to work with? How do they decide to work with you all on this panel?
I mean, it's like any other long-term relationship, right? Well, hopefully long-term relationship. You don't have the benefit of dating as long as you might for another long-term relationship, but you got to kind of see if your goals are aligned, you respect each other. Would you want to work together? Do you want to go to dinner with this person? Do you want to, my test always is, would I work for this entrepreneur? And I think the entrepreneur is kind of, would you want to work with me, and do you respect me and trust me? I think there's a huge chemistry element to this business that matters more than most people give it credit for. I always cite this stat, and I knew you were going to ask this question today, so I looked it up last night. Average marriage in the U.S., 8.5 years. Like, many of our deals last longer than that, and we don't have as long to date somebody. So just be sure you're in it for the long haul.
But unlike with dating, where you might get in trouble for doing a background check, in this case, it's highly encouraged. So just like we're likely to do reference checks on you, et cetera, you ought to go find entrepreneurs we've worked with, entrepreneurs who we haven't, and why we haven't, or whatever, and do the background stack of, what are the things that would be helpful to me in an investor? Have they done those things for you? What's your relationship been like? Have they been accessible? But think first about the things that you would care about, and then go vet with other people whether the investors have actually delivered on those things. You're totally allowed to do that. And if a VC gets mad at you for doing that, then I would think that you should walk away, right? I mean, that's important.
Hugely second that element what just Kerry said, right? They're all their investments are showcased on their portfolio. Just reach out on LinkedIn and go talk to their people, entrepreneurs they've backed before, to get a sense of what they have to work with, so that you can, in the current time, you won't spend enough time because of Zoom, etc., where the chemistry is the most incredibly important thing, as Tom said. but go establish for yourself what others who can work with really think of them, and would you want to work with this person based on that.
Agreed.
I know when we get to term sheet stage, we're often just giving a list of all of our portfolio company founder CEOs to go due diligence on us. So that's all good stuff. We have a quick fire question at the end here we can run through and everybody give an answer, but what's the number one book you recommend all founders should read?
I brought books. All right, everyone always mentions this. I think it's super important. So this feels like it should just be table stakes. Venture Deals by Brad Feld and Jason Mendelsohn. It's not super scintillating reading, but it gets you on a level playing field on term sheets. But since everyone always mentions that one, I brought another one that is old, but I found really useful when I was starting a company, which was a really lonely, painful experience. And it's called Founders at Work. It was actually edited by Jessica Livingston, who was an early Y Combinator partner. But it's stories of, some of these really big companies, or they were big at the time, like Hotmail, Lotus, et cetera, and what it was actually like in the early days. It sort of reminds me of like the book version of How I Built This. There was a lot of hustle and a lot of pain and a lot of things that weren't as glossy and successful as you see today. It may be dated, but I certainly found it like a helpful companion when I was doing entrepreneurship.
How about you, Tom?
Well, I've got a partner who would probably kick my butt if I didn't say this. He just actually wrote a book. And so he's got a book that I think you can pre-order it now. We've got a bunch of them around the office here. I'm sure he would autograph it for somebody that wants to come by. He actually just texted me the first 50 I'll autograph. I'm pretty sure he'd autograph it for anybody who's listening to this. It's called Mr. Monkey and Me, and it's a pretty interesting book that Mike wrote, and I've known Mike for 20 years. He talks about his kind of entrepreneurial journey when he was running this company that he ended up ultimately taking public, and kind of some of the hard kind of mental things that he went through. He gives you kind of an actionable approach to mental toughness through being an entrepreneur. It's a pretty good read. It's an entertaining read for entrepreneurs, I think.
What do you recommend?
Cool.
Krishna?
Oh yeah. I asked my partners, and a popular one seems to be getting to plan B. But to be more contrarian, I just think, being a founder and being successful is such an experiential deal here. And so I would really recommend books to you outside of the sphere of entrepreneurship. And books I've read this year include, I went back and reread Founding Brothers. You're a founder and you want to deal with your founders, and how our founding fathers did amazing things and yet made a country happen, to Infinitely Powers, which talks about the history of calculus. Fun books to read, which are outside the realm of entrepreneurship.
The history of calculus, huh? That's a good one.
Infinitely Powers, highly recommended.
I'd say actually a little different tact. I'd say read Fred Wilson and Brad Feld's blogs. There's a ton of data in there. They're little snippets, but super valuable as you're starting a company. Fred Wilson from Union Square Ventures and Brad Feld.
Yeah, great bloggers. I'll throw in a fun one for everything not to do. The book Bad Blood.
So good.
Sat on a lot of boards and watched how companies operate. I literally read that with my mouth open the entire time, in awe of what all happened in that story. So great story. I think we are wrapping up. Thank you so much, panelists, for your time today. I hope the audience got as much out of it as I did. It was great chatting with you all, and look forward to see you soon.
Yeah, thanks guys for another great panel. Carrie, Mike, Charlie, Krishna, and Thomas. It was great hearing about how Texas VCs have navigated this pandemic, and also get some insight into how things are evolving moving forward. And specifically loved hearing all that good old Texas hospitality from you guys, being so welcoming to the new California-based funds that have been moving to Austin recently. So thanks again for your time this morning. Before we continue moving on, I do want to give a quick plug for Capital Factory President Gordon Dougherty's upcoming Founders Academy program. This is coming up next October 13th through 15th. Gordon literally wrote the book on early stage fundraising, and this virtual course is a great chance to work with him directly to help build your skill set and successfully fund your startup. We'll be dropping a link to register here in the chat, and I highly encourage anyone who's available to sign up. Next up in the fundraising track, we've got a quick networking break before our next panel, Fundraising Alternatives to VC, which starts at 11 a.m. To access networking with the other attendees, just press the networking icon on the left side of your screen. You'll get randomly paired up with another attendee, and you'll have about 5 minutes to chat with each other. Very important, if you'd like to continue that conversation after the 5-minute session, click the connect button at the bottom of your screen, and you'll both receive an email introduction from Hopin that'll allow you guys to keep that conversation going later. So go ahead and get to networking, and I'll see you back here right at 11 a.m. for the Fundraising Alternatives to VC panel.